Let me know if this sounds familiar to you. You have a great idea, right? You're going to start a business, you're going to make all this money, change all these lives. And then when you actually start to walk out the process, there's all this paperwork, a ton of options for how you're going to claim your taxes. What kind are you going to be, a corporation, sole proprietor, an LLC? What does it all mean? And what is the right selection for you? Welcome to our channel. My name is Kate. My business partner and I, Cheryl, own and run Empower to Profit, where we focus on helping small business owners get more profit into their own pocket through their business. So what we're going to hop into today is taxation and election for those taxations, what all of these words mean, the differences, the benefits, to help you try and find out which one is the best fit for you and your business. I know it can be confusing. Even when I was starting my first business and when Cheryl and I even partnered up, I had to walk through these things slowly, carefully, read a million things, watch a million YouTube videos. And the whole time I kept thinking, there's got to be a better way. Why is nobody explaining this in a straightforward, clean cut, easy to understand way? What I'm going to try and do today is break it down in bite-sized pieces so it can make at least a little bit of sense to help you make what the right decision is for you. So the first thing I want to review is entity type. What does entity type mean? So an entity type is simply the legal structure of your business or organization. So we have the legal entity type and then the taxation type, we'll say. So one doesn't always mean the other. It sometimes can. So I'm going to walk through what that looks like for a small business owner. And I will just say straight up, there is a ton of information on this. That's why it can get complicated fairly quickly, especially when you're dealing with laws and regulations. It can get a little hairy. So I'm going to try and stick to the bases. We're not going to dig in too deep. Each one of these entities is a whole world in itself. And I want to start out with saying we are not tax accountants. We cannot be held liable for anything we say in this video, but I wanted to make this kind of just like a quick tip, so you can just get entry level information into your brain to help you have a basic understanding on how to at least just start to move forward. So let's jump into it. Your entity type is important because of its potential legal and financial implications it has on you and your business. It indicates how much you pay in taxes, your legal liability. If your company comes under fire or litigation, are you at risk or is just the business at risk? How it can impact your profit and your growth potential in the business. And you want to be sure to choose the right entity type to set your business and you up for success while minimizing risk as much as possible, right? So there's debatable whether there's 4 or 5 entity types. We're going to go with 5 just to kind of give you a broad perspective of what they look like. So 1, sole proprietorship, how most small businesses start out. That's how I started out. 2, a partnership, like Cheryl and I, 50-50 split. An LLC, which Cheryl and I are also an LLC. And then you have corporation, which are either S Corp or C Corp. So I'm going to break those out a little bit individually and just do quick key point things to lock in your brain to help you distinguish the differences. But again, there's a lot more detail of what these entities look like or what they really mean. So, sole proprietor. This means you are the sole owner of your business. You take on all financial and all legal responsibility falls on you, the individual. A lot of times these are side hustle, side gigs, just trying to get something off the ground, not making a ton of money yet. They are very easy to form. a lot of times a sole proprietorship does not require any legal paperwork. It's an opportunity that the government gives us that we can start a business but don't really have any legal hoops to jump through. But on the other side of that, you as an individual are 100% liable for everything you do in that business. So another benefit to that is you maintain full control. You don't have to answer to anybody. You run the ship. You make all the decisions. You don't have to turn, I don't want to say anything into the state, but very minimal requirements. Let's talk about self-employment tax, though, and what that means. You are subject to the self-employment tax under a sole proprietorship. So that's one of the, I will say, negatives, because you end up could be paying more in taxes if you are a sole proprietorship. It depends on your income level of your business. Great place to start out, but as you grow, we usually advise people to get out of that sole prop because it can start to bite you in the butt a little bit tax-wise. So for sole proprietorship, you're still filling out the 1040, not doing any extra forms. Very easy to operate, not a lot of hoops to jump through, but it can start to be a little bit bad on the back end with taxes. So we'll keep sole prop. We've dealt with that now. It's a great starting point. I did it myself. Number 2, a partnership. So there are 2 main types of partnership: general partnership and a shared liability. General partnership, shared equally, way less complicated. Shared liability partnership, this usually allows you to bring on financial investors that are not held liable for the business, but that means they also can't make any changing decisions to the business. They're just the money behind the scenes. They don't have any real power or deciding power. If you want to have that power human to human on the business side of it, that's fine, but legally they don't have any power in the business. So partnership isn't necessarily a taxation structure. So a partnership is more of a business structure. There's the difference there. So there's no legality to the partnership in terms of taxes. If you decide to do a partnership, great. And then you also have to decide on your legal taxation entity. So see the difference there? So let's talk about LLCs now. This is usually the most appealing to small business owners because it allows business owners and businesses to be separate liabilities, allows a lot of flexibility for how the business is structured and taxed, and it allows the business owners to claim taxes on their personal tax return. So it's kind of like the first step of separating your business from you as an individual. So your side hustle is more turning into a business now. You don't want to be held liable because your customer base is growing. You want to start that separation. You don't want to lose the house if some crazy client or customer tries to sue. So it builds that divide between legal or liability between owner and business, 2 separate houses. So with this formation and requirements, you do have to file with whatever state you are in and follow whatever their state guidelines are. I know in Florida, it's generally very easy. It could be more complicated in your state, but you have to I would advise going to your state website to see what all those check boxes are and what paperwork you need to complete and how much you need to pay to become an LLC. I think Florida was like $50, so nothing major, but you do have to file with the state. So members are not typically held liable for an LLC, and there's very few administrative requirements. And if there are, it's usually done by state. I know in Florida, we have to have like one meeting per year where we have to take notes and then submit that annually to re-register or keep our LLC standing. So little things like that, nothing too crazy, but there is some paperwork on the back end. So taxation, there's no tax at the entity level. Income is passed through to the members, and kind of like sole prop, you claim it on your taxes. And then you can move forward with your tax accountant, which however they want to work that. So let's talk about corporations. This is where things get a little bit more dicey. People kind of lose focus here and get a little bit more confused. So we have C Corp and S Corp. So corporations. The S Corp is kind of the next stepping stone when you're going from like LLC, sole prop, and you're making a little bit more money. Usually this is different people have different strategies. Anywhere between 60,000 profit, not gross revenue. We're talking pure profit. You as a business owner are making more than 60 grand a year. That's when we advise people typically start having these conversations with their tax accountant. When you're an S Corp, a big difference is you will now be on salary for your business. And this has to be a reasonable salary in your field of business. So I can't call myself a bookkeeper and be making $1 million a year in salary, because that doesn't track for a reasonable salary for somebody in my field, right? So there are hoops like that. In terms of formation, you do have to file with the state and whatever your state specific fee is. Shareholders are not typically held liable for the business. The business is a corporation, so it holds its own liability. Me as a business owner is not held liable. The business in itself is a corporation, so it's its own entity. So for an S Corp, you do have to have a director who manages the business activities. So you have to designate that person in paperwork with your state. And another plus why people like the S Corps is because you can pass down the business to a family member or shareholders, where in a sole prop, when the owner dies, usually the business dies. And I mean, you can pass it on, but the person getting the business is going to have to open up either a new LLC or sole prop and file it that way. So for an S Corp, going back to the salary is subject to tax. So you pay Medicare and income tax, or however it's structured for your individual state, out of your salary. With an LLC or sole prop, you're paying self-employment tax. So, and you're doing quarterly taxes that you as the individual are responsible for paying. So let's say you make $5,000 a month in your pay from your business, you are responsible as a sole proprietor to hold out your taxes and then quarterly pay those to the IRS. If you don't do that when tax time comes around, if you're not paying those quarterly taxes when tax time comes around, you are going to be due for them. So a lot of people, we advise paying them quarterly, so when that bill comes up at the beginning of the year, you don't own 17 grand or whatever that looks like for you. That's one of the biggest pitfalls we see with small business owners. So a lot of people like the S Corp because those taxes are paid out with their paycheck. And a benefit is, as the business owner, you can take that paycheck, pay the taxes, and then you can also take a profit check or like an owner's draw on top of that paycheck. Now that owner's draw is not taxed, that is pure profit. So I would advise setting a portion aside, 20% at least because it's better to have a buffer than have to owe, right? Maybe you're one of the crazies that like to owe, but those are the main differences there. So you're going to have to fill out some different tax forms. We're not going to get caught up in all of that, the legality of the S Corp, but that's kind of the broad perspective, the big points that people like to learn. S Corp, again, you file with the state, whatever your state dictates for that. And then shareholders, business owners are not held liable because, again, this is a corporation. It's its own entity. And then for a C Corp, there are election of board of directors, officers, there are annual meetings, there are annual reports due, lots of filing requirements. These are for the big corporations. These are usually for the big dogs. Smaller businesses if you go into the corporation world, tend to keep on the S Corp side. You're taxed at a corporate rate when you break into the C Corp world, which is where you get that double taxation. You probably hear that word thrown around a lot. It's a lot of times confused what that actually means, but that means you are taxed at the corporate level, and then again at distribution level to its shareholders. So you're taxed in the business, and then again on the shareholder distribution, which is probably what you're getting as a business owner. So that's what's meant by the double taxation. And then, of course, your salary is subject to that tax. I'm just going to keep it there in terms of talking points. But so let's recap. So when you elect an LLC, a sole prop or partner, you can be held liable, and you are responsible for quarterly tax payments. C Corp, this is where the big dogs usually play, million-dollar businesses. This is where you fall into double taxation. Business is taxed, and then the shareholders are taxed. S Corp is not a tax status. I'm sorry, it is a tax status, but not a business structure. So you pay taxes out of payroll, and then you can also take a profit in addition to that you are responsible for covering taxes on. So again, if you're making more than 60K, and you're still a sole prop LLC, definitely worth having that conversation with your tax advisor, a tax strategist, tax accountant, whatever that looks like in your world, because you may see benefits tax-wise for switching over to an S Corp. Sole prop, you pay income tax and self-employment tax, which is made up of Social Security and Medicare. So those are the kind of the big points. I'm going to stop there because it gets hairy really quickly, but I hope this at least helped organize the different structures and entities and what it looks like and the differences between all those. But if you have any questions, I would love to make a video or a reel or some content on like a question specifically what you have about the tax structures and how it works. But I hope you guys are killing it with your businesses. If there's anything you want to see specifically, leave a comment below, reach out, let us know. But as always, cheers to profit.